Right, good evening, everyone. Just a quick sound check and visual check, just to check that you can obviously hear me okay, and also you should be able to see my screen, which is a slide which says Impulsive versus Corrective price action. If you could just confirm that you can hear and see me okay, that would be great. Perfect, thank you very much. Right, okay, so good evening, everyone. Thanks for coming on tonight. Slightly different time to what we have done the previous 7 webinars in this series of webinars. We've gone for an evening one this time just to change it up and give other people an opportunity to join as well. Hope I've obviously recognised a few similar names as well. Great to see you guys here as well. But yeah, so the way that this will work is the actual core presentation will be about somewhere around 40-45 minutes long, and then allows for 15-20 minutes worth of Q&A afterwards. So we've gone through, in the first 7 sessions, we've gone through sort of the processes that you need to go through, the approach that you need to trade, to make trading a success, how to build the skills necessary, before we then started looking at some of the documents that you need to keep and analyzing your trading, setting your goals, and also we touched on last week the emotions that a lot of people struggle with, and how to manage them, and not let them dictate your trading decisions. We're now going to get into sort of like the core part and the more technical side of trading. All of the other stuff, hopefully you'll understand why that stuff is so important. You get that right first before you start moving into this stuff. So we're going to talk about a very simple core principle of price action called impulsive versus corrective price action. I'm not sure if anyone's already heard of this. It often gets overcomplicated, in my opinion. This is a very simplified way of assessing the markets and working out which side of the market has a dominant order flow, and therefore you can then determine which side you should be trading with and which side you should be looking to participate with in the market, and identify where the smart money is. So we're going to go through that and then tell you how to identify that so you can go away and practice that yourself. And then we're also going to give you a very, very simple strategy at the end, where you can go and practice this in simulating demo environments to really start getting used to trading and stuff like that. We will next week also go through another market behavioral concept, something that I base all of my trading decisions around. It's very much a smart money concept. It's about where the smart money is. And then obviously we'll also offer another strategy on top of that as well. So we're really getting into the technical side of things, giving you the tools that you need to go away and trade. But like I say, that the first 7 weeks that we've gone through, where we've really gone into the processes and stuff and the foundations, you really need to get that right first before we start going into this. So as always, we'll start the session with the disclaimer. I'm not going to read through it all, but I'll leave it up there just for a couple of seconds while we get a couple of other people into the join the webinar. Just so obviously trading CFDs is risky, and you need to be aware of the risks involved in trading CFDs. So I'll leave that there for a second for you to read through. All right, okay, so we're now going to move on to the main part of the session. So impulsive and corrective price action. As I said in the introduction part, this is a very simple way of identifying where there is an imbalance of order flow, and then being able to recognize which is the most dominant side of the market. Once you can recognize the most dominant side of the market, you can then position yourself with that side of the market. You know where the smart money is, you know what side of the market is controlling the direction of the market. Therefore, that is a side of the market that you want to base your trading decisions with. Now, as I said, also it's often overcomplicated. You've probably heard of Elliott wave theories, a variety of pattern names. There's so many out there: bull, bear flags, ascending, descending, wedges, triangles, ranges, channels. There's so pennants. There's so many head and shoulders. All that. There's so many different variety of pattern names out there. However, if we practice our pattern recognition skills of identifying a much more simplified version of these patterns, we're always going to be able to identify the most dominant side of the market at any one particular time without having to find ourselves subjective to these subjective patterns, because often these patterns can be subjective. One person sees it one way, another person sees it another. Maybe on a channel, somebody sees the edge of the channel very differently to the other. But I've been able to identify and understand impulsive and corrective order flow and price action. We're just going to simplify and find out, right, this is the most dominant side of the market, therefore that's where we want to be basing our trading decisions on. And if we're in a corrective phase, which we'll go through in a minute, then we want to be looking for more range bound. We don't want to be trading momentum strategies, we want to be trading range bound strategies, and we know then where the edge of the ranges are so that we know where our trade locations are. So once we've identified the most dominant side of the market, we should position ourselves with that side on the majority of our trades. Once we get a little bit more experienced, we can start taking counter trend trades from like higher time frame support zones and stuff like that. But very much initially, you want to be sticking with trend as much as possible. You want to be sticking with the dominant side of the order flow. They say trend is your friend, and that is definitely a good thing to base your trading on, especially when you're starting out. Now, we're going to look at an impulsive move now. We will go through some examples, some charts and stuff as well. An impulsive move suggests that there is a strong imbalance in the market where one side is much more dominant over the other. When we can recognize that we're in an impulsive move, we want to look to position ourselves with that side of the market. So if we're in an impulsive down move, we want to be selling. If we're in an impulsive up move, we want to be buying. That doesn't mean so we want to be buying and selling blindly. We're going to show you a strategy in a moment whereby we can actually take advantage of this. But you can identify an impulsive move by the following characteristics. The candles are all going to be of the same color, or the majority of the candles are all going to be of the same color. So if we're in an impulsive up move, the majority of them are going to be green. And if we're in an impulsive down move, the majority of them are going to be red, or whatever color settings you have on the chart. The candles are going to finish close to their highs or lows close to their highs when they're moving up, or close to their lows when they're moving down, with very, very little wicks on show. And a wicks is the stick of the candle rather than the body. The candles are not going to generally overlap as the momentum is all in one direction. The candles are generally going to open and carry on in the same direction. They're not going to be retracing and overlapping candles. They're not going to be like this really sort of like choppy price action. They're going to be very much moving, opening and moving in one direction. The candles can often be larger than the average size as well, because again, there's a dominant side of the order flow the other side is not resisting too much. Therefore, the candles are going to be moving further. So generally speaking, the candles are going to be larger than the average size of the candles, previous candles to them. And they're going to be moving through levels of support and resistance without any pause. When this happens, it tells you that support resistance zone is not being respected. There's not even enough buyers or sellers at that support resistance zone to stop this momentum that is with that side of the market. When that happens, you know that there is one side of the market that really is in control of the market at that time, and that is the side of the market that we want to position ourselves with. You will often see any retracements in an impulsive move held by the 8 moving average, and the EMAs are going to be pointing in the direction of the trend and often expanding. Now, we spoke about earlier on in the series about the indicators. The 8 moving average is the fast moving average, and it will generally be holding that an impulsive move. It will at least be holding the 20 moving average, but often it will be holding the 8 moving average to suggest a really strong move. Holding times will generally be shorter in impulsive moves, and therefore we can also look to hold runners on our positions to maximize profit. So again, we spoke about scaling out as a money management technique and reducing risk. Once we've reduced the risk on our position, we can actually hold some of that position when we see we're in an impulsive move, to really run with that momentum and try and maximize the profits. Once we've made our trade risk-free, maximize our profits on a portion of the trade. Now, a corrective move is almost like the opposite of the impulsive move. It suggests that there is two-way action in the market, much more balanced in terms of the buyers and the sellers, with neither side being more dominant over the other. So this is when you're going to get those sort of like ranges that people call them, and channels and stuff. When we recognize that we are in a corrective move, we want to identify clearly defined structures and look to position ourselves at the extreme edges of the structure, or with a bias towards the preceding impulsive move. I'm going to talk about why that is in a moment. But just remember, if you see yourself in a corrective structure, you want to find clearly defined edges to that structure. If there are no clearly defined edges to that structure, then you don't want to be trading it. If you can find the clearly defined edges, then you can trade those edges. And if you've had an impulsive up move going into that corrective structure, then you want to try and position yourself with the bottom of that structure, with the support of that structure as much as possible. How can you identify when you are in a corrective structure? The candles are going to be varying in color, so they're going to be very much a mix of red and green candles. You're not going to have like one set of candles being more dominant over the other. There's going to be a lot more wicks on either side of the body of the candle. Apologies, there's a typo there, but there's going to be a lot more wicks on either side of the body of the candle, because the buyers are going to be pushing back when it sells off, and the sellers are going to be pushing back when the market rallies. So there's going to be this sort of like the tug of war, this jostling, and it's going to create a lot more wicks on either side of the candle, because no one side of the market is in complete control. The candles are generally going to be overlapping, as there is no momentum in either direction, and the candles can often be smaller or closer to the average size, because again, there's not this overall dominance in the market, so they're going to be much more closer to the average size, and perhaps even a little bit smaller. You see a lot more contraction in the market. Corrective moves will often oscillate above and below the moving averages, and the moving averages will often be fairly horizontal. So again, we're looking at ways in which we can use these indicators, not just to for trade locations and things like that, but really use them as visual guides to understand what phase of the market we are in, and therefore once we can identify what phase of the market we're in, we can then determine what strategies, what style of strategies we should be using, and which side of the market we should be trading from, and that will keep us much safer. Holding times in corrective structures will be longer, and we should also be more aggressive with our risk and trade management. Now, what I mean by being more aggressive with our risk and trade management is we want to go for smaller risk to reward targets, because the markets are not going to be moving as far. We want to be making sure our trades get risk-free as soon as possible. Yeah, just not being too greedy with our profits either. We want to be making sure that we get those trades risk-free as soon as possible and book our profits. Don't hold runners in corrective markets expecting for some big home run trade. They're not going to happen in corrective markets. Yes, when you're in a trending move, that's when you go for your higher risk to reward trades. But when you're in a range-bound market, that's when you really just want to go for your one-to-ones, get out of the trade and book your profits. Now, as mentioned, you've probably seen many times before, markets do not move in a straight line. So an impulsive move will often be followed by a corrective move in an area that the other side can find some value. So if the market is moved up very impulsively, at some point the market will pause and the sellers will find some value somewhere, in which case it will start to create a corrective move. Now, a corrective move is not just a horizontal channel. It can be like, it can be corrective moves can be retracements and stuff. So it's there's no one particular way of defining a corrective move shape, but once you see these sorts of characteristics, then you know you're in a corrective move. And just as we mentioned before, if you can find a corrective move with clearly defined edges, if the preceding impulsive move has been to the upside, you want to try and trade from the support of that corrective move as much as possible. And the reason being is the majority of the time, and approximately 70% of the time, the next impulsive move is going to be in the same direction as the preceding impulsive move into the corrective structure. So if you've got an impulsive move up, then you have a corrective structure, there's a 70% chance that the next impulsive move is going to be to the upside. So you can use this in many ways. You can try and position yourself as much as possible on the support side, or you can look for the market to break out from that corrective structure to get long again, and vice versa. If we are if we see an impulsive move to the downside and then into a corrective structure, there's a 70% chance that the next impulsive move is going to be to the downside. By being able to identify this, it gives us a statistical edge, as we can position ourselves with the more dominant side of the order flow in the market, and the side of the market that is more likely to break out than the other. Now, occasionally we can see an impulsive move, which will be followed by another impulsive move in the opposite direction, and that is called a V-shaped recovery because it looks like a V on the charts. And I'll try and find you an example of that actually shortly. Okay, so when you are checking your higher time frame context, if you see an impulsive move on your higher time frames, you should only trade with that side of the market on your execution or lower time frame charts. So I personally use 3-minute charts for my execution. I use my 1-hour chart for my higher time frame context. If I see impulsive moves on the 1-hour time frame, then I will only trade with that direction on the execution time frame. An impulsive move on the execution or lower time frame does not indicate a shift in the overall or longer term momentum of the market. So just because I execute on the 3-minute time frame, if I see an impulsive move on the 3-minute time frame, that doesn't automatically mean that I should shift my bias or it changes the structure or the overall analysis on my higher time frame context. I'm gonna, again, once we get into the charts in a second, I'm gonna explain this to you. And it's really important to know that as well, because you should determine your bias and you should determine your strategy based on the time frame that you are analyzing the markets on, which is your higher time frame context. Your execution chart is purely for execution. So you can get impulsive moves on a smaller time frame that is within a corrective structure on a higher time frame. When you see that, you still want to be waiting for the edges of that corrective structure on the higher time frame. Just because you see impulsive moves on the lower time frame doesn't mean to say you want to be starting jumping into trades. Now, for experienced traders, if an impulsive move starts moving quickly through zones, then we can look to higher time frame key zones of support and resistance if we're looking for areas to trade against the move. So if I start, to keep it simple, I trade off the 3-minute, I execute off the 3-minute, and I have my higher time frame context on the 1 hour. If I start to see impulsive moves moving through support zones on the hourly chart, I will switch to a daily chart. Again, move up an hourly, move up a time frame to look for key support zones on the higher time frame there, and then I will execute on the hour. So if I start seeing these impulsive moves and I want to trade against that trend, I will. So if I see an impulsive move on my 1 hour chart, I execute only on that lower time frame with the trend. But if I want to try and trade counter trend, I move up a time frame and I use the daily for my higher time frame context. I use my daily chart to identify the support and resistance zones, and then I execute on the hourly time frame. I would not execute against a trend on the lower time frames. Beginning traders, as I say, should be only looking to trade with the impulsive move as well. So we're now going to jump into a couple of charts just to start identifying these. And obviously, if you do have any questions, please chuck them into the questions channel or the chat channel, and I'll happily answer them. Or at worst, we'll go through some questions at the end of the session. So here you can see this red box here that I've drawn around. You can see that the majority of the candles are red. They are fairly large in size. You have got a couple of wicks on show, but the majority of them these candles are closing on their lows, like here, 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 here. And just notice that the moving averages are very quickly pointing downwards. They are separating very early on in this move. You can see, you can identify even in these first sort of 3-4 candles that we're in a potential the start of an impulsive move, because the moving averages are separating, they're pointing downwards. And notice also that we can identify we're in an impulsive move because this box is very rectangular and vertical in shape, and that's a top tip. I'm going to go through this again in a minute. So if you draw a box from the high to the low of a move, and it's vertical and horizontal in shape, vertical and rectangular in shape, then you are in an impulsive move. Notice that we start moving into this corrective structure. Now we get this push up, and then very, very quickly. So even if you get caught a losing short trade in this area here, straight away, very quickly, these moving averages start to level out, and we can identify we're moving into a corrective structure very, very early on in this structure. Notice that the markets are oscillating, but the price is oscillating back and forth with moving averages. Again, very much a mix of candles. And notice also on this first impulsive move that we're very much holding the 8 moving averages. All of these characteristics that we mentioned in there, we can identify them very, very early in that corrective structure, in that move. Notice that throughout this structure, we do oscillate back and forth between the moving averages. Now, notice here that we did have an impulsive move, and there is no, when you actually see this, you see the impulsive move, corrective, and then you start to see this other impulsive move. So the corrective move, impulsive, corrective. At this point, you would be very much wise to think that we're starting another impulsive move. The moving averages start to separate again, and then very quickly again over here they start to oscillate, and we get back into this corrective structure. So hopefully you can see how we can actually start identifying the ranges and the structures that we're in. And then again, very quickly early on, we move into this green structure here. Very quickly early on here, within 1, 2, 3, 4 or 5 candles, the moving averages start to separate. We start to hold the 8 moving average, and you can see that we're moving out of this corrective structure into an impulsive move even before we've actually broken the top of that corrective structure there. So we can actually start getting into longs and identify that we're actually going to be breaking out. So again, very much a load of green candles holding the 8 moving average, closing on their highs all the way up here, and plenty of opportunities to get, if we can identify that we're in that impulsive move early on, we've still got lots and lots of room to get into trading opportunities within and take advantage of that impulsive move. And then again, so it takes a few more candles this time, probably about, what was that, for 7 or 8 candles before these moving averages start to flatten out again. But again, it's still very early on in this corrective structure that we can actually start to identify that the moving averages are flattening out, and we're starting to oscillate back and forth across the moving averages, and we're starting to get a mix of candles as well. So again, very, very early on in this structure, we can start to identify that we're going into a corrective structure and away from that impulsive move. And again, we want to then start switching our trading strategies from trend-based momentum strategies to reversal strategies, trying to identify the outer edges or clear edges, clear support and resistance zones of the corrective structure. So any questions on that at the moment? I'm also going to just show you a live example of the FTSE. Now the FTSE at the moment, over the last sort of like month or so, certainly throughout May, has created this sort of larger corrective structure. Notice that we have had a few sort of mini impulsive moves within this corrective structure. If I just put that there, you see this is a rectangular and vertical box in a lower time frame, that will identify as an impulsive move. But in terms of this overall corrective structure, that does not change things. And again, we've got another one here that we've got another impulsive move within that corrective structure. It doesn't change the fact that on the higher time frames we are still within a corrective structure. And the reason I'm saying this is in my analysis this morning with the FTSE, we've had this really long period of consolidation and range where you've got clearly identified resistance zone up here, this blue zone here, clearly identified support zones down here. And in my analysis to my clients this morning, I actually said to them that even though we'd seen this move overnight in the US markets, see here we've got this this move here in the US session yesterday, even though we'd seen this, an impulsive move, it hadn't changed the overall context of the market until we started breaking this 76.79 to 76.85 zone. And once we saw that break, then this impulsive move really has kicked in and moved lower. But all the time that we was in this corrective structure, we couldn't change. But also notice that when the market started to open this morning, we started holding these 8 moving averages, and that there was you notice on this impulsive move here, on the test back to the 8 moving average, we moved above it. On this move down here, as soon as we got back to the 8 moving averages, we just started oscillating. On this one, we moved down, moved up, we held the 8 moving average, moved down, up, held the 8 moving average, and then on the open this morning we started pushing down. Those are the indications that this is going to break that structure, that corrective structure, and we can get involved in. And this is all coming off the higher time frame context. So it's analysis on the higher time frame context, and then moving down to your execution chart for the trade opportunities. So that's just a real live example in terms of what I was actually looking at today in the markets. Okay, so moving on from those charts, we're now going to look at a strategy. We're going to provide you with a potential strategy that you can use to take advantage of when you're in a impulsive move. This is a trend-based strategy. It is not a range-bound strategy. We're going to teach you a range-bound strategy next week. And we're also going to show you a little trick, a little market behavioral trick to identify the best trading opportunities and the best times to trade when the smart money is getting into the markets next week. But this is going to be a trend-based momentum strategy for you to use in impulsive moves. So we're looking for strong trending moves, and then corrective pullbacks to the exponential moving averages, and then for these moving averages to act as dynamic support resistance and then continue on the trend. We are basically buying dips and selling rallies. We're going to, as we say, markets don't move in a straight line, even in an impulsive move. On the lower time frames, you are going to get retracements. They're going to be very shallow retracements, but they are going to retrace. You see, even on those examples there, they did retrace back to the 8 moving average, and those are the times that we want to be looking to get in on those. We don't want to be just selling the lows because we're in a downward trend. We want to wait for those retracements back to the moving averages and look for to get in on the trade then. So for this setup, we need the 8 and the 20 moving averages plotted on our charts. And in trending markets, price will often revert to the mean, which is the 20 moving average, and continue on the trend. And if, as we've already identified, if the trend is very strong, often it's going to hold and react from the 8 moving average. Now, these are commonly used indicators. From my time in the city, I know that these are actual indicators that traders use. A lot of the other retail indicators that you see pushed and pumped out there are not used by the smart money traders. They're not used by institutional traders. So that should tell you something in terms of their relevance. However, I know that a lot of institutional traders will still use moving averages. Now, because of that, because many traders monitor them, they almost become self-fulfilling indicators, because so many people are looking at them, the smart money is looking at them, the volume is there going to be looking at them. They therefore become much more relevant than some of these other retail-based indicators that just are not widely used and are lagging indicators, which is why I tend to use very, very few indicators on my chart. So what we want to see is we want to see a strong impulsive move in one direction, and it should cause separation between the 8 and the 20 moving averages. Now, we've just touched on this. A top tip: if you draw a rectangle around the price from its lowest point to the highest point, it should be rectangular and vertical in shape. We then, once we see the low in, we want to see a corrective move. So we want to start seeing slight on the lower time frames, slightly more two-way action, move back to the moving averages. Now, if the move back to the moving averages is strong or impulsive, we should not trade, as we may be trading against a V-shaped recovery or false break scenario. And again, a top tip on this: if you draw a rectangle around the price from its lowest point to its highest point, it should be more rectangular and horizontal or square-like in shape. As soon as you start to get square-like in shape, that is when you are getting into corrective phase. And if it starts to become horizontal and rectangular, then you know that you're in a longer phase of corrective movement. If we're in a very strong trend, we can look for a signal candle from the 8 moving averages, but if we break the 8 moving averages, we want to wait for price to connect with a 20 moving average before we look for our signal candle. Once we have met the two criteria above in terms of impulsive and corrective price action, we are then we don't just enter on a touch of the moving averages. We're going to look to identify a signal candle. So once we've seen the impulsive and corrective movement, we've connected with the moving averages, that part of the thing is done. Our decision making is over in that part of the process. We're now just looking to identify a signal candle. Now, what should a signal candle look like? As this is a momentum-based strategy, our signal candle should close on its highs if we're looking to buy and the original impulsive move was to the upside, or on its lows if we're looking to sell when the original impulsive move was to the downside. Now, it doesn't have to be like literally right on the highs or lows. We ideally want price to be closing within 25% of the highs or lows, and certainly no more than 30%. The closer the better. Ideally, really in the sort of top 10, 15% of the candle. If it is a candle that's just opened and moved straight in one direction, and then there's this little pushback of 25, 30%, I'm less inclined to really use that as a momentum candle. What I would use as a momentum candle, if it closed sort of like 25% within its highs, is sort of a pin bar whereby the market's pushed down and then the buyers have stepped in, or vice versa, and we're closing within 25% of the highs, because it says that there has tried to be some downward pressure, but those buyers have just stepped straight back in and pushed it back up again. Now, once you see the signal candle, which is that strong candle finishing with close to its highs if you're trying to buy, or close to its lows if you're trying to sell, your entry is going to be a break of the buy in the direction of the original impulsive move. It's not just going to be a blind entry. You're going to wait for that candle to break. So you're going to enter just above that candle if you're buying, or just below that candle if you're selling. The stop is a break at a swing high or low that is created in the opposite direction of the impulsive move. So just below the swing low created if you're buying, so or just above the swing high created if you're selling. We're going to go into some examples to really show this in a moment. Your initial target should be back towards the high or low of the initial impulsive move. And again, we're going to show this in an example in a minute. You need to make sure that you have at least 1-to-1 risk reward, preferably higher. Now, I say the initial target because you can run some of these, you leave your runners to go higher, but you certainly want to be making yourself risk-free around that 1-to-1 risk reward, around the initial high or low that's been created. As it is a trend-based trade, we want the trade to move quickly into profit. And if it doesn't, as an example, say within the first 4 or 5 candles, then we can look to close at entry or move stop to entry if possible, to just minimize the risk, reduce our risk if we haven't got that momentum with the trade. Because otherwise maybe we've misread, maybe it's a dodgy signal, something like that. We want this to be a momentum candle that keeps the momentum going in the trade, therefore we want it to move into profit and stay in profit quite quickly. We should try and trade these with the higher time frame context as much as possible, and with this we can always leave runners for a higher target once we have built our advanced price action skills, which we've talked about already. If the continuation move is also impulsive, this is also a signal that we can hold some of our trades for a higher target. So if you see that impulsive move on the execution time frame, see the corrective move back, and then start seeing another impulsive move in the direction you've got the higher time frame context moving impulsively as well, then we can start, is when we've really got a trade that we can start holding runners for. We only want to take the first 2 or 3 touches of the moving averages in a trend, otherwise the trend may start to get exhausted. Okay, looking at some examples now. So this is a trade on the DAX. Now we saw this trending move up on the DAX. Notice again, lots of green candles holding that 8 moving average. The box is very much a rectangle and vertical in shape. Just out of interest, we had a zone here. We got the, again, we can see that we started separating here. The moving averages are moving away from each other. We had this zone here. We got this move up above this zone of potential resistance. And then we got this move back. Now, although these candles are red, notice that there's a lot more wicks on show. And notice how these, the moving averages are actually leveling out. We then get this strong bullish continuation candle. So once we move back to the, notice that these candles are smaller as well. Once we move back to the moving averages, we now are looking for a momentum candle. This is a bullish candle that closes very close to its highs, and therefore that tied in with the zone that we had today. Therefore, that is a valid setup. Now you'll notice here that all I'm doing is showing you what you want to be looking at the moment. A lot of traders, a lot of educators will show you the perfect setup that goes and wins. Now, this is counterproductive from a psychological point of view, because you don't know when you enter whether you're going to win or lose that trade. So from a psychological point of view, if somebody shows you all of these winning trades, the setups that you need to see and identify, when you actually are faced with that pattern again, and it loses, because there will be losing trades, you will look to try and identify what you have done wrong, and you will think that you've done something wrong, because all you've seen is that when you see this pattern, it goes on to win. What you need to understand is this is what you see, this is what you base your trading decision on. Whether this trade wins or loses is irrelevant. Whenever you see this pattern, you need to be executing the trade. Whether it wins or loses is just going to be one trade in the selection and sample of your overall trading database. So I can tell you this trade actually was a winner, but it doesn't, like I say, it's actually irrelevant as to whether this trade wins or loses. What you want to do is identify what you will see in real time when you have to make that trading decision, because once you've entered that trade, that is it. It doesn't actually, whether it wins or loses is irrelevant for that one particular trade. It's what happens over the larger sample of data. So moving on to another example, we have this impulsive move down illustrated by the rectangular vertical box. All the larger candles are red in color. We have some slight corrective, mini corrective pullbacks to those 8 moving averages. And if you this is a 3-minute chart, but if say this was a 1-hour chart, you start seeing this impulsive move down. These sort of like 3 or 4 candles here would be a corrective structure on a 3-minute execution time frame. And when you start getting back to these 8 moving averages, which would be sort of like a 20 moving average on the 3-minute, that is an opportunity for you to short on the execution time frame. But looking at this, if this is the execution time frame, we see this as being a large rectangular impulsive move. We then get several candles. Notice how we get 1, 2, 3, 4, 5, 6. It takes 7 candles to retrace 3 previous candles. We come back, we connect with the moving averages, and then we get this signal candle finishing on its lows. Now, your stop would actually be above this original green candle that creates the highest high. So we're going to look at this now. This is a trade that we took. You can see your entry would be below the signal candle. Your stop would be above the swing high. And then you entered into this trade. You're targeting back down towards the lows of this original impulsive move, which is just about 1-to-1. And as you can see, you get your trade risk free, and then you can actually leave some as a runner to break down lower. Right, guys, so that is the end of the main presentation. So coming to you guys now for some questions, for some feedback. Has that helped at all? Does it seem like something that you can use? Have you seen that before? Do you have any questions? Please, the floor is yours. Peter, I can see you've raised your hand. If you'd like to type in the chat box or the questions box, I'd be happy to answer any questions that you have. We have about 15-20 minutes or so to go through some questions. Any feedback, guys, on this is much appreciated as well. Hopefully you can see how being able to identify what phase of the market you're in can really help keep you on that right side of the market. Okay, guys, do we have any questions at all? Just a quick sound check, making sure you can hear me. If somebody could just post in and yes, that you can hear me, that'd be great. Okay, John, perfect. So we've got so no, I mean, so John's saying, am I taking a wider macro view into consideration when I'm trading with these impulses? No, I mean, basically, I don't look at fundamental news whatsoever. For me, if you start trying to guess, look at fundamental news used to work really well, certainly pre-GFC, the global financial crisis. After the global financial crisis, often, you know, what would be generally perceived as good news could actually be bad news and vice versa. So you saw this sort of like really weird price movements, especially around like really large economic announcements where the expected move would be reversed or it'd be the opposite. So you have to be aware of fundamental news and what's going on to manage risk. So, for example, you wouldn't enter a trade going into non-farm payrolls. You wouldn't enter a trade going into FOMC, Bank of England. You wouldn't leave yourself exposed over weekends when, like, Russia and Ukraine are at war. All those sorts of things, you have to be aware of them. But I'm a firm believer that the way that the market will perceive the macro environment is translated into the charts. And if you start trying to second guess what somebody else is trying to think of the sentiment of the market, you're just adding another layer of decisions that you need to make, and you're trying to decipher. So it can just confuse the decision making. So it's much easier. It's better to just simplify it. We're playing a game of probabilities here, right? We don't have to be right every single time. If the market is communicating something to us, follow what it is communicating to us, because also, you know, I have a general bias in terms of what I think is going to happen in the market. But I've learned over the years, you know, do what the market's telling you it's doing. Don't marry into your bias. Like, I'll give you an example. Back end of last year, I really felt like a lot of traders that, and a lot of people, you know, with the war in the Ukraine, the cost of living crisis, the high inflation, etc. We're going to go through a really tough period or in the equity markets, which I trade and stuff. So, but back end of last year, I was expecting this really sort of painful period, But at the back end of last year, I actually started seeing the market communicate to me that, you know, the downtrend was over and we was actually going to start seeing some upside, and that has actually played out so far this year. So even though I had a particular bias that we was going to go down, and in the moment we were seeing some bearish signals, and I was very much short selling the shorter time frames, started to see this sort of shift in the charts, and managed to change my bias and be dynamic to that. So it's very important. I believe, I'm a firm believer that the market will communicate to you what the sentiment is. The market is how it's determining the macroeconomic environment. So I just make sure that I read the charts, and that's what I base my decisions off, rather than being creating a bias on the wider macro environment. So yeah, sorry, I'm rambling a little bit there, but I hope that answers that question, John. Please can I show which would be the signal candle at the start of the move? Are you talking about in the start? So the signal candle at the start of the impulsive move, or the signal candle for the actual execution of the trade, Cynthia? The signal candle at the start. So for this impulsive move, you don't really probably start to identify the impulsive move until about this sort of area here. But we're not looking to trade in this impulsive move here on this execution time frame. So execution of the trade, you see, if you've identified this impulsive move, you then get a pullback to the moving averages in this sort of like move up here. Then it's this red candle here with the arrow above it. That would be your signal candle, because that is the one that's closing on its lows. That is the bearish signal. It's moved back to the moving averages and closing on its lows. And then you would enter just below that candle. Does that make sense, Cynthia? Exactly. Yeah. 100%. You need to wait for things to develop. Don't just jump in because you've seen impulsive moves and you see moves back to the moving averages. Like, you have to have a plan, and if you don't see that plan, basically what you're trying to do is take all decision making out of trading, right? Basically, what I can identify from here is, right, I've identified an impulsive move, so I'm looking for corrective pullbacks to the moving averages. You know, once I know that, all I need to do is wait for it to move back to the moving averages. Now all I need to see is a signal candle, which is a candle finishing on its lows, a bearish candle, and I execute. I'm not overthinking things. I'm not trying to look for other factors or trying to second guess myself. It's literally a case of, right, there's an impulsive move, there's a corrective move, there's the moving averages, there's a signal candle, execute. You're taking all of that decision making away from you. You create a clear, structured plan. You take the decision making away from you, because if you allow your too much ambiguity in your decision making, you're going to allow your emotions to hijack and make your decisions for you. If you have a strict rule based, I mean, this isn't like a clear mechanical system like some people profess to have, but it is a fairly clearly defined set of rules. Impulsive move, yes. Corrective move back to the moving averages, yes. Signal candle, yes. Right, then I have to execute the trade. It's perfect. Cool. A pin bars to be watched as reversal signal even when below the 8 EMA. Yeah, you can trade. So you would want the pin bar to be finishing on its lows still, but yes, of course, yeah, pin bar. You would, yeah. Are you looking at sort of this pin bar here? So a pin bar to the upside, because that there's still a little bit of movement, like one pin bar. And again, do not give too much emphasis to one particular candle in a chart. This pin bar to me is completely irrelevant, because it's just one candle in the bigger context. I just want move. I've identified the impulsive move. I now just want price to move back to those moving averages, and then I'm going to look for a signal. And whatever these candles, if I get inside bars, outside bars, pin bars, you know, what dojis, I don't really care what these candles are, as long as that move is corrective and I move back to the moving averages. I look for my signal candle, I get in. Because if I put too much emphasis on that pin bar, I'm not going to enter that trade, because this pin bar is telling me the market's going to go up. But why is that one pin bar giving me any better? Why is that pin bar giving me more information than all of this move together? It doesn't. It's irrelevant. It's one pin bar in the face of, like, I don't know how many candles that is, 25, 30 candles or something. So it really is irrelevant, because the overall context is telling me something completely different. So it's just having that structure and then trying to shut out the rest of the noise. If you try and analyze every single candlestick, we're going to be creating too much noise. Okay, yeah, Bill, 100%. I totally agree. Fundamental news is better for investing than day or swing trading, 100%, because, you know, fundamental news will have a long-term impact on the markets, and as we've seen, you know, for the day traders. So, you know, when COVID hit, when Russia invaded Ukraine, I had a lot of friends and colleagues and people talking to me and family and stuff come up to me going, "Oh, you must be really struggling in the market at the moment." It's like, no, because I can actually go short the market. I'm bearish in the market at the moment because of what's going on. So I can make money from the markets going down. Yes, people's portfolios lost money, but longer term view is they hold that and they sit through that, and they know that the stock markets are generally going to go up, but they're going to sit through some short term pain on a longer term investment strategy. So yes, fundamental news has a much bigger impact in terms of bigger idea on your longer term investing, but actually in the shorter term, it can create volatility. Volatility is good for us as day traders, because it creates opportunity. So because we can short the market and go long, I sit down with a completely clear mind at the start of every single trading day. I don't hold positions overnight, very rarely do anyway. So every morning I can come to my charts and I can come with a clear mind, determine what bias I have, what side of the market I'm going to trade on that day. So actually the bigger, wider macroeconomic environment is sort of irrelevant to me, because, you know, if something changes today, I can switch my bias tomorrow. So yeah, John, I personally don't use volume because, like, FX is very difficult to read volume, because it doesn't actually give you the real trading volume. When you're trading indices or stocks or something like that, then yes, you should be more suspicious about the potential of continuations on lower volume. Like I said, I don't personally use volume, but I know traders that do, and yes, 100% you would look at it in that way. The one thing that I would sort of sit there and say is, on days where I know there's going to be low volume, so for example, if there's a public holiday or something like that in the markets, or, you know, the US are off, or we're going, like, do you know what I mean? When it's clear that there's going to be lower volume because there's fewer participants in the market, if I see an impulsive move on that day, again, I will place less relevance on it. And in fact, if I see those big moves when I know there's low volume, I'm suspicious of it, and I'm almost going to try and look to trade against it. The following session, I'm going to be looking for false breaks. I'm going to be looking for it to break back into ranges and stuff and take advantage of it, because I know that moves on thin volume and it's less likely to be a legitimate move. So yeah, you can use that on a much smaller intraday basis if you use volume in your trading. I personally don't, but yeah, it would certainly be a legitimate tool to use. Yes, I'm a Keyzone trader. Yeah, so Keyzone Traders, I have several services, which you can find on my website, www.keyzonetraders.com. I'll put it in the chat box. I have several services and stuff that are educational and provide market analysis and stuff like that, depending on your level of experience, your level of activity, your goals of trading. No matter what they are, there are different services there. So yeah, please feel free to come visit my website and drop me an email. My contact details are on there as well. You can use the contact me page, and happy to answer any questions that you have. Just checking you can all see the my website link in the chat box. Perfect. Okay, guys, so we are coming to the end of the session. If there's any other questions, happy to field them. Other than that, look forward to seeing. I'm actually I'm on holidays next week, so we're going to take a short break in this education series. We'll be back in 2 weeks' time. If you can, I highly recommend you make the next session. It is the one shift in my trading which made with the biggest change in my results, biggest transformation in my trading when I spotted this and I actually used it to my advantage. If you have ever seen or heard anyone talk about, you know, stop hunting, the market moving and market being rigged because the market just goes and stops people out, you're going to want to be on this next session, because it's going to show you how to identify when that happens and actually go with that rather than fall victim to it. So it can be a massive shift in trading. It was a big shift in my trading. I'm going to tell you why it happens. I'm going to show you it happening, and I'm also going to show you a strategy on how you can actually use that information to actually profit from the markets and get really high probability trade locations. No, Cynthia, that's going to be in 2 weeks' time. So 6 o'clock on, bear with me, the 7th of June. 6 o'clock on the 7th of June. We'll be here with that one. Okay, everyone. Well, look, thanks for taking your time this evening. I hope you found that useful. And yeah, as I say, feel free to check my website, send me some emails. I'm happy to answer any questions, and I look forward to seeing you in a couple of weeks. Perfect, cool. Cheers, John. Yeah, look forward to seeing you all in a couple of weeks' time, and I will speak soon. Have a good couple of weeks, and I'll see you then. Cheers, everyone.